Hershey. Who tried Hershey before? I'm sure everyone did, right? I remember before I even left Russia in 1990s, I already tried Kit Kat. I really like this. I still probably my favorite. And I don't know, we definitely have this Hershey in Australia. Probably other. I'm not really keen on sweets, but I presume we have quite at least Cadbury's, it's also Hershey brands, and at least it was. And I believe that they have huge, so when you're buying chocolate, I'm sure you're making money for Hershey in this particular case. Now, I didn't want to analyze, first I wanted to analyze specifically this industry, food processing industry, but when I start reviewing it, I realized that Hershey has a bit, kind of, it's not really, like it's so diverse industry that we cannot put it together. We cannot compare eggs and like apples, okay, they're different. So same right here, because some food processing companies, they're really struggling because of power, buying power of huge supply chain shops like Walmart and stuff like that. They're really struggling because they're squeezing their margins, and a lot of food processing companies, they're not making a lot of money, okay, or even slowing down their earnings. Whereas Hershey's probably one of the different companies because it's constantly increasing their sales, it's constantly increasing their profitability. It's not growing as fast as other companies which we looked over last year, but it's constantly growing. That's what I love about this specific company. But it doesn't grow organically. It grows through buying other chains. And recently, they just this quarter they bought Amplify Snack for 1.6 billion, and probably also that the price of shares market situation. 2 years ago we purchased Hershey with our club members because they bought Golden Monkey in China, and when they bought it, they didn't get what they were promised. Okay, they kind of it was oversold to them, so they expected good presence in different shops, like in shop chains in China, but then it wasn't the case, and the sales didn't come as they expected, as high as they expected, and the share price, funny, it dropped from 100 something plus to nearly $82. And for me, it was really strange because if you buy another chain and chain is profitable and you are profitable, and now you're kind of creating more sales, more profit, why the price would be 20% lower than before? But still, people sold off the company. We bought it. We were buying at $85 level, $90 level, and it went all the way to $110 pretty quickly after we analyzed it in the club meeting. I remember, probably Max, you were there when we discussed it. It was 99 York Street. I remember we looked at this specific company, and after that, like I know I purchased it. I don't know if you bought it or something like that. So, but definitely it was a fantastic company, and then it stayed quite a while high, and now it's dropped down again, and I was pretty happy to see it that it's dropped, especially at this particular time. I thought that would be a fantastic company to put in a portfolio. Okay, let's have a look what was going in a company. So we can see it's not that cheap company. So it's 22 P ratio when the price was $113. Now the price is $9.75, so it's $13 less, so more than 10% down. So we can expect that the P ratio has to be low as well. Okay, so it has to be 10% low, so around 20s. Now value line sees this company between 120 and $165 in the future with the next rates. It represents 20 to 65% growth. Okay, so it's higher than here before, because they put this data from 113. If we go for sales and earnings, I want to pay attention what was happening during this crisis in 2008. Let's have a look. So we can see it's $20 per share, $21.40, then $21.70, $22.60, $23.20, $24.90. there is no slow even in sales. So they were growing, they were selling more and more and more. So whatever crisis was there didn't affect them at all. But if we look at, and now if we go again, so since that moment, every year they kept growing. $23.20, 24, 20, 29, 31, $33, $34, 35, this year 35.80, and they continue to grow. Of course, black or bold numbers, they are projections. We have to take it into consideration that company projecting that they're going to make money. But I always look where earnings predictability. What do we see here? 100%. So they are 100% right. So if they tell 100 times that they're going to do it, they do it 100 times. That's statistical number, which is fantastic. Okay, in our case, another company which we saw it was Nike, and something else we saw it 100%, but it's definitely difficult to find company like that. Now, if we look from earnings perspective, again, we'll start from that period. We can say that it was making $2.3 before the slowdown, and then you can see it starts selling less, like making less money. So it's $2.08 and then 188 in 2009. So that was the lowest earnings, and then it started growing, and then again 217, 250, 280, 320, 370, 390, 412, 440, and 485. When we analyzed company last time, it was making $4.12. Now it's making 20% more money than it was making at that time. So the company was selling more product but making less money. Their earnings dropped nearly 20% from the top level, so it was 234 and here 188, like less than 20%, about 15% drop here, right? Something like that. But look at the price. The price of the share was $56, even 7 here, and dropped to 30. So nearly 100% drop, like, okay, maybe 80% drop. So halved, okay, so not 80, halved of it. Imagine how people felt at that time. But internally, fundamentally, company was as strong as before. And the drop which they had happened because they reduced the margin. We don't see the margin previously here, but we can see that the margin was, where is just a second margin? Maybe we'll see it. Operating margin, you see it was 23 and then it's become 19. So they were selling more products, but they reduced the margin. So they kind of started giving more discounts to customers. And as a result, they made less money. But then they increased back margin to the same level practically. Okay, even higher than before. Okay, the next thing, dividends. Dividends quite healthy, and even during that uncertain time, they kept increasing it. On the 1 year they had flat, and after that, each year they increasing the dividends. I'm going to show you how much money you would make if you just buy the shares like 30 years ago and kept them. Okay, if you like using dividends just yield for something like that. Another good thing about that, oh, actually what I wanted to show you, look at sales here. 1 year was drop in sales. It was 7,421, 7 billion, sorry, 421 million, and then 7 billion 386 million in sales. So sales went down in a company, like as a company. But if you look at the share price per share, you will see that it actually was growing. It was 33.60 and then 34. Why do you think it was happening? How come like the company is making less sales, but per share it's more making more sales? We already discussed it many times, but can you tell me? Any ideas, especially for you? Yeah, correct, Dean. So they're making repurchase of shares, and we can see that it's constantly buying back shares. So it was 220 here and now 216. So they bought some of the shares, and they're going to do it kept going in the future. So which is good for us. Okay, they're buying back shares in this specific. But at the same time, if you look at the earnings, because for us more important earnings, despite the sales drop, they kept making more money. Okay, there wasn't drop in sales, and it's actually a very good sign. And the reason why I believe it's a good sign, because what happens in this particular case, they're selling more product, very less product, but they're optimizing their expenses, and they're still making. So it's like they stopped giving discounts, less people buy it, but because they have higher margin, they're making more money. So, which is good in our particular case. And if you see here, that's what exactly we see. So it was 22.4% margin here, and it was 23.3%. So it's 0.9 points they increased in revenue. So for each $1,000, they make extra what, $9, right? So no, $9.90 for each $100. So, and that's kind of when you see in billions of dollars how much they sell, that generate extra revenue for them. Now, another thing which we need to pay attention is debt. We can see that that is $3.1 billion and capitalization $24 billion. So it's not the big that big debt. It's about 13%. And but at the same time, I took it into consideration when I was putting points for the company, express analysis, and you will see that because it's above 10%, I gave it 3 points, not 4. If it was 10 or below, it would get extra points in quality when we analyze for quality. But remember that it's only 3% above that that level of 10%. So it's quite strong position with that debt. So it's nothing terrible might happen here because of debt leverage and stuff like that. Especially if we look at earnings, net profit, we can see that they have $1 billion in profits. I presume they can pay it easily from the profit. If they take all the profit, decide to pay that debt within 3 years. And in reality, maybe even faster, because if you look at cash flow, you can see cash flow here is $4.8, but the earnings $4.8, but cash flow 6.20. So it's what, about $1.40 above that price. So it's nearly 30% higher. So I presume if we look at it as a company, so it would be $1.3 billion in cash flow what they're receiving. So they can easily pay this debt, no trouble here at all. Now, different thing about that company, if you compare, which also you have to take into consideration, is working capital. What the working capital, it means that the level of current assets is less than current liabilities. They short 250,000. But again, we looked at similar companies which have huge like bargaining power. What they can do, they can get cash when they sell something, and they pay their suppliers like in certain amount of months, and they can use their cash. But still, it's not a good thing when we see negative working capital, and I'm going to show you here. So we can see that currently current assets, they have $2.2 billion and current liabilities 2.3 billion. So if all these suppliers come to them and ask them to give them money, they won't have the money on their account. Okay, this is the thing which you have to pay attention. But from other point, we know that because their like loan debt is quite small, they can always go to the bank and ask for money. But still, we have to pay attention to this. From margin perspective, I already mentioned it, and we can see that the margin is growing, which is good sign, and they're going to increase it more. So it means that they're optimizing their expenses, they're optimizing their supply chain, and they're making more money on each dollar they sell of the product. And also we can tell same thing, net profit margin. So it's went from 11.7, here it's 8%, and they're planning to have it nearly 16%. Okay, so it's like nearly double within 10 years of margins, which is fantastic. It's really, really good. Okay, we looked at previous companies like, for example, BBBY, Bed Baths and Beyonds, and we remember that they had 11% of net profit margin and now have only 5. So they go in different direction, right? So than Hershey. So Hershey is pretty good on that particular case. Also wanted to pay attention to dividends. we can see the dividends near half of what they make. And because they make more than a half right now, 53%, when we're doing express analysis, 4x4 analysis, you will see that they get less points for that. But remember, it's not always a bad thing to pay, especially when the growth rate is not as fast. It's good to return money to the shareholders that you could invest it in a more aggressive growth company. Okay, in this particular case. But again, it's lost some points because of that during the analysis. Okay, business from the company, as I said, they bought this Amplify company. And the interesting thing about this specific company, they're doing like kind of products like popcorn or whatever stuff, chips, cookies, and chips. And this company, Amplify company, was considered like a second fastest growing company in US. And people believe that Hershey, after bought this company, their rate of growth could be a bit faster because they were growing 6% and 10% in earnings, and they projected 2.5 and 7.5. So these numbers might change in the future because they bought this fast-growing company. It will affect the growth Hershey as a whole company. Okay, this is a good thing. Now, who knows how long company is on the market? I don't think it was said here. Who knows that? It doesn't say here. Just curious. Do you know how long this company exists? It exists from I think 1896 or something like that. 1896. So it has a huge track record. And before that, 20 years prior to that, it wasn't chocolate company. It was a caramel company, but also kind of a sweet company. And then the owner of the company said, okay, caramel is just a fad, it will disappear, but chocolate will stay forever. And he was right. The company was growing, and now it's represent itself in more than 60 countries. Has different brands, a lot of brands within it. And this company, which they bought, Amplify, it's actually would be a sixth biggest brand within that, like Hershey company. Also, the interesting fact about it that Hershey Trust company owns 8.4% of the common stock. Hershey Trust is the like share which was owned by owner. I think his name was Michael Hershey, and when he was dying, he didn't have any children, so he just created a trust, and 30% of income which this trust receives, they pay to some school in United States, which now is biggest school because the profit is huge, and they're providing free education for children. So it's like charity. 30% of their profit goes to charity. And you can see that other officers and directors own 6% of the company. Oh no, sorry, 1% of the company. Vanguard has 6% and BlackRock 6%. Biggest, I presume, money managed funds, they own the specific company. So okay, that's about fundamentals of this specific company. So what do you think about, is it a good quality company or not good quality company? What can you tell? Slow and steady. That's probably would be the best description, Dean. Slow and steady company. Absolutely. The only thing which we're missing that they have some debt, right? So they're not growing as fast as we like, because when we're looking for some companies making a lot of money, we look for companies which have growth like definitely not 2.5%. We're trying to find 10 or more. Okay, and this specific case it's slow growth, but for this type of uncertain times when we don't know if the market is going to crash, what happens, how long it's going to be, it's always good to have some kind of companies which are secure. Even share price might fall, but still you would be fine for the long term. And from price point, we can see that PE ratio in average for the last few years, it was 24, 24, 23. Okay, so it was about on those ranges, and now it's nearly 20. So that's why we can see it's about 15 to 20% below the price which we had 2 years ago. Again, it's average. It still can go a bit lower, but it can go back to the same levels, about 24, even 26. Okay, so we have to consider that. So it is undervalued, but not as deeply undervalued as other companies which we looked like during our previous master classes.